Well, did you ever feel this situation and you said to yourself, I have 5 years left until retirement. I have done my part. Surely I can just coast from here. You look at your retirement account and see $500,000, maybe $750,000, maybe $1 million, and you think that number alone means safety. You assume the hardest work is behind you. Here is the thing. The final 5 years before retirement will likely determine whether that balance turns into steady income or slow stress. Small changes now can mean the difference between withdrawing $4,000 a month with confidence or lying awake at night wondering if the money will last. Stay with me, because in the end, I will give you a clear checklist with real numbers you can pause and screenshot. My name is Judith Carver. I am a senior protection educator, and I focus on helping adults over 60 understand financial and legal risks before they become expensive mistakes. This content is for educational purposes only. I am not a lawyer, and I do not provide legal advice. My mission is simple. I want you to feel calm, informed, and in control. And remember this, our rights do not expire with age. Let us begin with a number most people misunderstand. If you are 60 and have $600,000 saved and you plan to retire at 65, the growth on that account matters more now than your contributions. If your investments earn an average of 6% in 1 year, that is $36,000 in growth. If they earn 8%, that is $48,000. Compare that to contributing $10,000 per year. The growth is doing more work than you are. This is what I call the tipping point. Most people never notice this shift. They focus on adding money, but at this stage, protecting reasonable growth becomes more important than squeezing in small extra deposits. Now pause for a moment. Imagine the market drops 15% in your first year of retirement. On a portfolio of $800,000, that is a decline of $120,000. If you are also withdrawing $40,000 that year to live on, your balance could fall to around $640,000 before any recovery. That is sequence risk. The order of returns matters. A bad first year hurts more than a bad 10th year. Watch out for this. The risk is not average returns over 20 years. The risk is poor timing during withdrawals. So what is a reasonable withdrawal target? Many planners reference around 4% annually as a starting point for discussion. On $1 million, 4% equals $40,000 per year, or about $3,333 per month before taxes. On $750,000, 4% equals $30,000 per year, or about $2,500 per month. But here is where it gets interesting. That is gross income. Taxes still apply on traditional retirement accounts. If your effective combined federal and state tax rate is 15%, that $40,000 could become about $34,000 after taxes. That changes the monthly number to roughly $2,833. Numbers matter. Let us talk about real expenses. According to recent national data, many retired households spend between $4,000 and $6,000 per month, depending on housing status. If your mortgage is paid off, you may spend $4,000 monthly, including property taxes, insurance, utilities, groceries, transportation, and health costs. If you still carry a mortgage of $1,500 per month, your required income could easily reach $5,500 monthly. That is $66,000 per year. If your portfolio provides $40,000, the remaining $26,000 must come from Social Security, pension, or part-time income. This is the part nobody talks about. A balance alone does not pay electric bills. Now let us bring in Social Security. The average retired worker benefit recently has been roughly $1,900 per month. A married couple might receive a combined $3,500 depending on work history and claiming age. If you delay benefits from 62 to 70, monthly payments can increase significantly, sometimes by more than 75% compared to early claiming. But delaying requires using other assets first. That decision must be coordinated carefully with taxes and life expectancy considerations. Speaking of taxes, here is where many seniors lose quiet money. Withdrawals from traditional retirement accounts, such as a 401k or traditional individual retirement arrangement, are taxed as ordinary income. If you withdraw $50,000 in 1 year, that $50,000 is added to any other taxable income to determine your bracket. For married couples filing jointly, crossing certain income thresholds can also increase Medicare Part B and Part D premiums. Those surcharges are called income-related monthly adjustment amounts. Even a few $1,000s above a threshold can increase premiums by hundreds of dollars per year per person. Most people never notice this connection until the bill arrives. This is why planning withdrawals matters. For example, spreading distributions evenly over several years instead of taking one large withdrawal for a home renovation could keep you in a lower bracket. Converting portions of traditional accounts to Roth accounts during lower income years might reduce future required minimum distributions. Required minimum distributions generally begin in your early 70s under current federal law. Those forced withdrawals can push taxable income higher whether you need the money or not. Stay with me. Tax timing can be just as powerful as investment return. Now let us address healthcare costs. Once you reach 65, most people enroll in Medicare. Standard Part B premiums in recent years have been around $170 per month per person, though higher income retirees may pay more. A supplemental plan or Medicare Advantage plan can add additional premiums ranging from $0 to several $100s per month depending on coverage. Out-of-pocket costs such as deductibles and prescriptions can easily add another $300 to $500 monthly. For a couple, total health-related expenses might reach $800 to $1,200 per month. Ignoring this category is dangerous. Housing is another critical number. If you own your home outright, property taxes in many states still range from $3,000 to $8,000 annually. Homeowners insurance may cost $1,000 to $2,000 per year. Maintenance often averages 1% of home value annually. On a $400,000 home, that could mean $4,000 per year in upkeep. These are not dramatic figures. They are ordinary, but ordinary expenses compound quickly. Here's a gentle reality check. If you have $800,000 saved and need $5,000 per month after Social Security, that equals $60,000 annually. At a 4% withdrawal rate, you would need about $1,500,000 to sustainably support that level from investments alone. That gap does not mean failure. It means adjustment. Maybe expenses reduce, maybe retirement is phased, maybe part-time work covers $15,000 per year for the first 5 years. Small strategic moves now prevent larger sacrifices later. This is where it gets serious. Many seniors underestimate inflation. Even at 3% annual inflation, prices double in roughly 24 years. If you retire at 65 and live to 90, your cost of living could nearly double over that period. Keeping some growth exposure in your portfolio helps protect purchasing power. But balance is key. Overly aggressive positioning invites volatility. Overly conservative positioning invites erosion. The right allocation depends on your timeline, goals, and tolerance. And please do not forget estate basics. Review beneficiary designations on retirement accounts and life insurance policies. Ensure you have a will, durable power of attorney, and healthcare directive compliant with your state law. Without these documents, families may face court proceedings that cost time and thousands of dollars in legal fees. Organization today protects dignity tomorrow. Let us bring this together calmly. The final 5 years before retirement are not about fear, they are about clarity. Know your monthly spending target. If it is $4,000, confirm how much comes from Social Security and how much from savings. If it is $6,000, map the gap honestly. Understand that 4% of $1 million equals $40,000 per year before taxes. Recognize that Medicare premiums, property taxes, and inflation are not side notes. They are central. Now here is the promised checklist. Pause this video and screenshot this section so you can review it later. First, write down your exact monthly target, whether that is $4,000, $5,000, or $6,000. Second, list guaranteed income sources such as Social Security, pension payments, or annuities and total the monthly amount. Third, calculate 4% of your current portfolio to estimate a starting annual withdrawal and divide it into monthly income. Fourth, estimate taxes by reviewing last year's return and projecting a realistic rate such as 12%, 15%, or 20% depending on your bracket. Fifth, confirm annual property taxes, insurance, and maintenance averages so there are no surprises. Sixth, review Medicare premiums and supplemental coverage costs and project at least $800 to $1,200 per month for a couple. Seventh, evaluate whether you have 1 to 2 years of expenses in accessible reserves. Eighth, schedule a meeting with a licensed financial professional and, if needed, a licensed attorney to review estate documents and beneficiary designations. If this information helps you recognize a pattern or avoid a mistake, share it with friends, neighbors, or family members who may face the same challenges. Many seniors fall into trouble simply because no one explained the numbers clearly. A simple conversation can protect someone you care about. If you find this guidance helpful, like and subscribe so I can continue providing information seniors are coping with every day. I read your comments and messages personally, so do not hesitate to reach out. Carry this knowledge forward with confidence, and always remember, your rights do not expire with age.